Hello out there. This is Monica Brashear with the Brashear Group and Sotheby's International Realty, and we are going to talk today to our expert lender, Jon Sanderson. Jon is with Supreme Lending, and he's going to answer all the questions that you've been dying to know. Good morning, Jon.
Good morning, Monica.
How are
Thanks.
you?
I'm very good. Thank you. Thank you for having me here this morning.
Of course, we're very excited to hear what you have to say, especially in this environment recently of increasing interest rates. The Fed this week just announced that they were increasing them another 3/4.
Another 3/4, 75 basis points.
Okay.
Right.
So,
Yes.
so talk to the buyers and sellers out there about this. This creates trepidation in their minds.
Sure.
And so speak to that a little bit.
I'm happy to. Actually, what the Fed is doing is exactly what they're supposed to be doing. They're supposed to be taming inflation, and that's the reason why they've been increasing rates. There's a lot of people out there that are a little bit skeptical about the Fed and how much they've increased rates this year.
Right.
You're going to hear that skepticism, but our belief is that what they're doing is going to achieve the ultimate goal. That is their job, to tame inflation. And once they do that, once there's evidence of that in the market, prior to the Fed actually stopping raising rates, we're going to start to see mortgage rates come back down before that, because mortgage rates are usually forward looking.
Okay.
Versus the Fed is using data from a rear view mirror.
Gotcha.
So we're optimistic that rates will come back down. It's a matter of when. We need to get some data behind us, of course, to show that what the Fed is doing is taming inflation.
Got it. And I think the Wall Street Journal and maybe other news outlets and authorities also reported this week that the Fed indicated that there would be some other increases coming down the road.
That is correct.
So that says to me, tell me what it says to you, that they don't think that they're going to be able to tamper inflation soon.
That is what the indicators point to right now. But again, it's always about the data that we get. And the data that we get, like once, as an example, inflation is measured by CPI, the Consumer Pricing Index, that kind of thing.
Okay.
That information is always reported around the first or second week of each month, but it's for the previous month. And so again, that's kind of in the rear view mirror. So once we start to get new information that shows that that's starting to come down, then the Fed is going to say, okay, maybe we can tap on the brakes a little bit. And this particular Fed raising that we had this week was very optimistic initially at 2 o'clock Eastern time, which is 1 o'clock here. The market started to rally as if
it increased. It went up. I thought they liked it, and I was super excited. And then by the end of the day, it reacted differently. Why?
Well, that's good. This was the very first time I took and put a split screen of the Federal Reserve Powell on one side, and I put the market on the other side.
Wow.
And I watched it, and it's pretty amazing every word choice that he has and how it can impact the market. And in this particular case, when the announcement came out that there was going to be a 75 basis point increase, which everybody knew was going to happen, the market started to rally, because one of the positions in the Fed's statement was that maybe they're going to start to taper the rate increases.
Okay.
Well, then Chairman Powell came out and started talking about it at the press conference. And surprise, surprise, he started talking about, well, we're just going to make sure that we get this under control, and we're not going to stop until we know it's done.
Okay.
So those kind of things kind of spooked the market a little bit.
Got it.
But you know what? I will say this. After every Fed decision or every unemployment report that comes out, there's always a knee-jerk reaction. And then it's typically within a day or two that things start to balance out. And we're starting to see that again.
That's good.
Yeah.
That's good.
Exactly.
I guess we all know that, you have to have housing,
Yes.
whether it's an apartment
Mhm.
or a rental
Right.
or the house that you own and live in.
Mhm.
We have to have housing.
Exactly.
So we can't just live our lives based on these interest rates.
Correct. I agree.
A buyer asked me recently, or made the comment to me, I'm just going to wait until the rates go back down.
Hmm.
And I understand that sort of rationale,
Sure.
but I said back to him, you do know that we're not going back to 2 and 3% interest rates for a long, long time,
Agreed.
if ever.
Right.
And so,
That's
can
very
you
possible.
talk to that?
Sure. Well, I love the fact that you gave me this question because this is something that I'm extremely passionate about. In my opinion, real estate is always a great investment. And to wait based on where interest rates are right now, you're going to lose out on an opportunity to build wealth. That's
Okay.
always been my position. So if let me talk real quickly about the 2 to 3%.
Okay.
Having interest rates there again. I agree. That's probably going to be a long shot. I think we can be back in the threes again. I don't know that we could get down to the twos. And the reason I will say that is because we need to look back at the last 3 years and what we went through. We went through a pandemic that hasn't happened in many, many years. Anything of this magnitude in the society that we're in now.
Right.
So fiscal environment. So there was a lot of investment by the Fed to make money less expensive in order to spur the economy to get it going. It was inevitable that situation like we're in right now was going to happen because you cannot continue to pump in money into the economy and not have inflation at some point.
Too much money.
Too much
chasing
money.
Too few goods.
Exactly.
Including homes.
Very good. Thank you.
Yeah.
Because I couldn't remember that one. So, but that most likely, unless there's some other kind of world catastrophe or something of that magnitude, I don't think we'll see that happening again. But the Fed in all of these years has gotten very good at keeping inflation under control. And so when they get inflation under control and they get it into that 2% range that they're looking for,
Okay.
then money will be less expensive. But again, I don't think we'll be back to that 2 to 3. I think we could get back to those threes though. So,
which would be amazing. I mean,
yes.
I remember, and this will date me, but when my parents purchased a house, them paying an 18%
Exactly.
interest rate.
And they bought a house.
And they were,
They bought a house.
they didn't have a lot of money. But they bought a house. And and so did the rest of America.
Exactly. And when they refinanced at 13%, they thought
Yeah.
they were like, wow, look at this. This is amazing.
Right.
So if I could go back to the whole thing about waiting, I'm really passionate about that again. Real estate, in my opinion, is always a positive thing because 2/3 of Americans' wealth is created by the real estate. Okay. So if you think of somebody that's worth $1 million, basically 600,000 of that is from the fact that it's in real estate.
Right.
Okay. Let's use those numbers as an example. So real estate, buying it now or buying it later, you're just, in my opinion, you're slowing down the opportunity to build that wealth. And so I like to use the example of when I first purchased my house, I put 5% down and my rate at that time was 7.5%.
Wow.
Okay. And I think it was probably 4 or 5 years later.
And what was the purchase price of that first house?
Well, I'm dating myself a little bit here because that was in the mid 90s.
Okay.
And so I purchased that property for $80,000 and sold it 4 or 5 years later for about $100,000.
Okay.
Okay. And that gave me the opportunity for my next house, which was brand new, which was only $153,000. Everything is relative. Right?
That's right. That's right.
That gave me the opportunity to then put 10% down
Right.
on that next house. Stayed in that house for 10 or 11 years, sold it, was able to put 20% down on the house that I live in now. And the house that I live in now, because I've been there for 10 years,
Mm-hmm.
I now have about 50% equity in my property. So that's why I say waiting is not necessarily what you should do, because you want to start that wealth building now,
Yes, you need to
as soon
start
as
it
you
as soon
can.
as you can.
And
From compounding to, if you wait till that great interest rate shows up to buy, everybody's buying, and then so prices
prices are
tend
going
to
to go back up.
rise because you're
That's exactly
competing
right.
against all these buyers.
Exactly. And while that time comes back, you're increasing your value of your house.
Well, and what would you say, John, along those same lines to my investor clients who, so we've talked a little bit about owner occupancy situations and wealth building, but I have a lot of investor clients who would like to get another property,
Sure.
who work on their portfolio and their wealth building through investment properties, and even clients who would like to purchase that first investment property to diversify.
Mhm.
What do you say to them and these interest rates? Because we know that investment property interest rates are even higher
That's
because
correct.
they're riskier
That's correct.
than those for
Mhm.
owner occupants, for homeowners.
Another great example of, in my opinion, buy now,
Okay.
because you're going to start that wealth building process. Yes, the rates are higher, no doubt. But we also look at rents. Rents are probably a little bit higher
They're
right
higher.
now,
They're
right?
higher.
And this environment, and back me up if I'm correct, there may be some opportunity to get some pretty good price houses, maybe.
Oh, absolutely.
Okay, so then,
Right.
yeah, take advantage of that. For the investor or for the primary resident, there's going to be an opportunity to refinance. Absolutely. So if, we're all making sacrifices right now, I think we would all agree, with our daily spending habits.
Right.
We may not be dining out as much or whatever. So this is the time to kind of buckle up, and putting it in real estate is something that's not going to lose value. Over time, it's going to continue to increase in value. I have a service that I subscribe to in Montgomery County, just as an example. Over the next 5 years, is expected to increase in value by 22%.
Oh.
So if you're an investor and you look at the fact that maybe you're paying a higher rate today, but at the same sense, you're building equity as you collect the rent payment, pay the mortgage, that's paying down principal, building your equity, along with the appreciation that you're going to get over those 5 years of 22%, you're going to be winning, just like that primary resident will be.
It's a good answer.